What does it mean for a system to be doing well? This is Bill Scheid from Applied Finance Research, and that's the question we're going to answer in this video. After a recent Patreon video, one of our community members mentioned that PMA SPY appeared to be going through a difficult period. And I think he said that because in the calendar year 2025, we see that PMA SPY had a lower total return percent than S&P buy and hold. And I found his comment interesting because it differs from my own subjective experience of trading PMA SPY. And really, his comment led me to a broader question, which is, what is the quantitative definition of saying that a system is going through a difficult time or a good time? Or really, what does it actually mean to say a system is doing well? For me, I don't believe that there's a universally right or wrong definition to this question. Systems are built around specific objectives, and whether a system is doing well, to me, depends on whether or not it's meeting those objectives. And your objectives have to fit you as an individual investor or trader. So that means that there are as many answers to this question as there are traders or investors in the world. So for me, all of this reduces down to one question, and that is the system performing within its statistical expectations? So for me, when I evaluate PMA SPY or any system, I look at the Monte Carlo projection cone from the historical backtests. And that's what we have here on the screen. We have a Monte Carlo projection cone using a backtest that goes all the way back to 2007. And the blue dots are the actual backtest trades. And what we've asked the Monte Carlo simulator to do is to project a Monte Carlo projection cone that begins at the beginning of 2025 and tells us, if we didn't know where 2025 was going to actually go, what would we expect running 1,000 Monte Carlo simulation runs on the prior backtest trades. And we get this cone in which the gray line is the average, and the upper side here is the 95% confidence limit, and the bottom is the lower 95% confidence limit. So the way that I read this is, if performance is inside this cone, that is considered statistically normal behavior. If it's above the average path, then it's experiencing some favorable variance, so we'll just call that lucky. And if it's below the average, then it's experiencing unfavorable variance, and we'll call that unlucky. But as long as it's inside the projection cone, that means it's within its statistical parameters. So when we look at what happened during calendar year 2025, we see that the system actually ended slightly above average. So we say that this is within statistical parameters and just a little bit luckier than average. Now, when we roll this back a little bit and we do a Monte Carlo projection cone from the beginning of 2023 all the way through the end of 2025, and I picked this because 2023 is when I first started teaching PMA SPY at the Van Tharp Institute. In this instance, we see that system performance is actually quite a bit above average. It's still within statistical parameters, but here we would call this normal behavior on the lucky side. Now, yes, the system did have a lower return than the S&P this year, but we also see that the system had a much lower maximum drawdown. In fact, that's about 55% of the maximum drawdown of SPY, so we see it's almost half. And to connect this back to the question of objectives, we have to remember that PMA SPY is not designed to generate alpha relative to the index. It's a capital protection trend following system. So its objective, first and foremost, is to avoid major bear markets and then to participate in uptrends when the market conditions are favorable. So for example, back in the spring, we see, this was the tariff sell-offs here, we see that the system moved to cash It didn't exit at the exact high up here or up here. It exited here, and it didn't get back in at the exact low, which was down here. It got in here. So I think what's important to remember here is it shifted to defense mode in case the decline got worse. Could the market have dropped further and gotten worse? Absolutely. In fact, history shows that from 1900 to 2025, the average depth of all the bear markets greater than 20% is 35.5%. Again, this analysis goes all the way back to 1900 and runs through 2025. This is a piece of research I put together for the book that I'm co-authoring with R.J. Hickson called Smart is Not Enough. So in the environments that we're talking about here, in these bear markets that are greater than 20%, what's really important is the ability to sidestep large losses. And that's actually what creates the long-term edge for PMA SPY. That's what we see when we look at the performance of PMA SPY through the Great Depression. This is another piece of research that's going into the book. It's a backtest of PMA SPY versus the S&P 500 from 1929 to 1940. And we see that during the crash of 29 to 32, the system was in cash for most of that major drop. In fact, it was in cash for most of the five major bear markets that happened between 1929 and 1954 when the market got back to break even. So sometimes making less than a benchmark in the short term is the cost of maintaining defense in the long term. And a good defense, of course, is the key to a good offense. When we look at the modern history of SPY, actually what we see is that having a strong defense hasn't cost us anything. The CAGR of the system is 10.8 while SPY is 10.6. So we actually got paid to play defense by 0.2% in this backtest window, and the maximum drawdown of the system was about half of the S&P 500. So is PMA SPY doing what it was designed to do? In my analysis, yes. Now, would I prefer every system to grow at a going for the moon rate and outperform the S&P 500 every year? Of course, absolutely. But we operate in a probabilistic world. There is no holy grail system. Systems are, in fact, built around objectives. They work because of statistical edges, and of course they are subject to variance. A 12% year while preserving the ability to sidestep those major bears, to me that is not a disappointment. That is just standard execution. I don't mind making 12% on my way to achieving the long-term expectancy of the system while avoiding the worst case drawdown in the short term. And according to Dr. Van Tharp, that's the key to success in the markets. Avoid the worst case in the short term and achieve the long-term expectancy in the end. So long story short, that is how, or should I say long story long, that is how I define whether a system is doing well. This is Bill Scheid from Applied Finance Research. Thank you very much for watching, and happy investing.